All right, thank you so much for joining me in this video lecture. This is Gurpal Singh from Gursur Education, and today we are going to talk about very important and very, we can say, knowledgeable topic in the series of video lectures for financial management. And almost, I think this is the last part for financial management because till now we have talked about more than 90 to 95% of financial management. All the topics we have already covered in detail, like capital structure, sources of finance, cost of capital, then leverage, then capital budgeting, working capital management, and whatnot. So that is going to be regarding the dividend decisions. Okay, so till now you would have got the knowledge of how you raise funds and how you apply these funds. And we have talked about the objectives of financial management in detail as well. We have talked about the profit maximization and wealth maximization. So whatever the earnings are available for equity shareholders, this is the final balance which belongs to the actual owner of the company. Okay, so company has two options to use these funds. Okay, so whatever the earnings are available after payment of all the things to all the external parties, whatever the funds is left, the company is having two options to utilize or use these funds. So the first option, they can repay this back as a dividend to their equity shareholders, and the second option, they can retain their earning, that is pluffing back of profits, so that if in future they get some profitable opportunities somewhere else, they can invest their money into those investment opportunities. So how you should use these funds? So these kind of decisions are known as dividend decisions. Okay, so there are two schools of thought. The first is dividend irrelevance theory, the second is a relevance theory. Okay, so these schools of thoughts have the separate perception regarding the value of the firm if you pay the dividend, if you don't pay the dividend. So these are the things we are going to talk about in this video lecture. I shall be teaching you whether the payment of giving dividend do really makes any profitable thing for business or not, of value of the firm increases or decreases, what happens to the value of a firm. There have been some authors, like the famous theory has been given by Modigliani and Miller. So they have suggested something. After that, Jordan has suggested something. So these kind of men have suggested that whether you should make the payment of a dividend or not, and what should be the optimal balance or optimal criteria for that. So these things we are going to talk about. I hope you'd enjoy this. Now I'm just going to share the screen. Enjoy and clear your concepts. All right, so now I hope the screen is visible to you. You can see it's written the topic name. This is dividend decisions, and this is very important now. So now we are going to cover the final portions regarding the financial management, and I hope you would have gone through from all the previously given concepts, because the financial management subject is about all the interrelated topics. Okay, so that ultimately means if you have gone one step further, it is presumed that you have the complete knowledge of the previous one, and in this way the structure goes up. Okay, so if we talk about a dividend decision, then ultimately assumes that you have all the prerequisites and the previous knowledge of all the concepts which are necessary under financial management. So you must have the knowledge of a capital structure. Okay, this is most importantly required, the knowledge of a capital structure. Then obviously the cost of capital, this topic is to be understood in extreme depth of knowledge, because its knowledge is necessary for understanding dividend decision. Then obviously capital budgeting and working capital management are there. So these are some ancillary topics which are also necessary for understanding dividend decisions. So now going to tell you the reason why we have to study dividend decision. This is a very important topic because so many times the questions has been asked from dividend decisions. So you know that when the firm has earned sufficient profits, okay, sufficient profits in the sense that I have given you the specific table so many times, in which first of all we write the EBIT, this is earning before interest and tax, and after that we write the deduction of interest in that figure. Then whatever the value is left, this is known as earning before tax, and after that the tax is deducted from this value, and the final balance is always earnings available for equity shareholders. Okay, so this is equity shareholders. Now what you can do with this fund? Okay, so this fund can be utilized in two different options. Either you can pay this fund directly to equity shareholders, because this ultimately belongs to the equity shareholders, and if you do that, then this is known as the payment of a dividend. But if you don't do that, you can just retain that earning, and that ultimately becomes the part of retained earnings. And if this is the case, then this retained earnings also belong to equity shareholder, but this is not paid immediately to equity shareholders. Rather, this is written on the liability side of a balance sheet under the head of reserves and surpluses. And when you have written that, that ultimately means you have some spare funds which you can utilize if you ever feel that there is next investment opportunity. Okay, so there is next investment opportunity. So this is the crux of all this chapter. So you know that a business organization, the running business organization, can have the business opportunities so many times. Okay, suppose you own a business organization and it's been now 5 years you are successfully running a business. Okay, maybe in the sixth year you are feeling that there are some more avenues in which you can make your investment. Okay, so so this is a company, so you, for that next opportunity, profitable opportunity or investment, obviously you need funds. So these funds can be obtained in two ways. Either you have to issue the fresh equity share capital, or you have to issue your debentures or preference share capital. Or the second way is that if you have previously retained earnings, then you can use those retained earnings for making investment in the next advisable uh, investment opportunities. So this is all that. Okay, so this is the role of retained earnings. But how these retained earnings shall be accumulated? These shall be accumulated only if you don't pay the dividend. If you don't pay the dividend, then you can retain the earnings, and these retained earnings can be used for further investment opportunities coming in the in the next future. So this is all about that. Okay, so there are some theories so which tell you that whether you should pay the dividend or you should not pay the dividend, whether you should pay the dividend or you should not pay the dividend. Because you know that if you don't pay the dividend, then all the earnings are retained for the next profitable opportunities. So there are theories which tells you that is it beneficial for you for the payment of dividend, or is this not beneficial for you payment of dividend? Does it increase the wealth of your shareholders or not? Wealth of shareholders or not? Okay, so on the basis of this specific criteria, there are number of theories which we have to cover. These are relevance theory and irrelevance theories of dividend decisions, which tells you that payment of a dividend is relevant to increase the increase the wealth of shareholders, or this is irrelevant. Okay, so these are the theories which we have to understand. Now I hope that in detail you would have got the idea of what the structure and what are the topics going to be covered in this video lecture. So one by one, from the basic to the conceptual understanding, I shall be teaching you everything in detail. So first of all, dividend is the payment by the company to its shareholders out of its distributable profits. Okay. So in other words, dividend is paid to shareholders out of revenue profits earned by it during the ordinary course of a business. So this is known as the dividend. So how you can determine the dividend? Okay, how much will be the level of the dividends to be paid, how much will be the level of your earnings, that is defined on the basis of these given points. Okay, so these points tell you what can be the next level of dividend. Okay, so how much will be the level of dividends in the upcoming years. So these have some determinants regarding which I think you must have the knowledge. First of all, type of industry. There are so many industrial types. Okay, so type of industry affect the payment of a dividend. Some industries never, companies in a specific industries do not prefer the payment of a dividend. Then age of a corporation, if this is so old, maybe it's not delivering any kind of dividends, or maybe it's delivering so many level of dividends. Then extents of a share distribution, this can also be the possibility. If a public holding is large in the company, then maybe the company is offering the distribution of a dividends. Then need for additional capital, if additional capital is needed, then maybe the companies retained their earnings only and they are not paying any kind of dividend. So that can determine the level of dividend. And then business cycle, sometimes there is recession, there is depression, or some other cases may be there. Business cycles also affect the amount of dividends to be distributed or retained earnings to be kept. Then changes in government policy, sometimes government can make it obligatory for some concerns to give a split or some other emoluments to their we can say shareholders. Then this will also affect the dividend. Then trends of a profit, if sometimes you are earning at a specific course, you are earning more profits, then obviously we can give the dividends. Then taxation policy, some shareholders prefer capital gains over the dividends, and some do not prefer, some prefer only dividends. Okay, so some prefer capital gain and some dividend, and on the basis of that the company can decide what shall be the level of dividends. Then future requirement, this is just the same as this point, need of additional capital. If you need the money, then you can retain the earning, that shall also affect the level of dividends. And finally, the cash balance also affect the level of dividends to be distributed. If you have maximum cash available at your disposal, then you can easily spend this money to pay the dividends to your shareholders. Now there are some well defined types of dividends, how the companies are paying dividends to their shareholders. The first are cash dividends, then stock dividends, then scrip dividend, then bond and property dividend. So I am going to explain all these one by one. Okay, so what we have to do one by one, you can understand these, and if the question is asked regarding a specific type of dividend, then you can answer this easily. The first are the kind of cash dividends. These are those dividends which are issued by the company, which are given by the company in cash format. Okay, so cash dividend by far the most popular form of dividend. In these dividends, stockholders receive checks for the amount due to them. So whenever the company, suppose it has to pay 10,000 as a dividend to a shareholder, it just issue the check for his name. So these are cash dividends. The second are the stock dividend. These are those dividends which are not paid in cash, but they are paid in the form of stocks. Okay. So the stock dividends rank next to the cash dividend in respect of their popularity. In this form of dividend, the firm issues additional shares to own stock of stockholders in proportion to number of shares held in lieu of cash dividend. Suppose a company has to issue 10,000 as the cash dividend, but they are not issuing the cash. Instead, they are issuing the stock to them. Suppose their market price is 1,000 per share, then they can issue 10 shares to that specific shareholder, so that the dividend payment can be made in form of the stocks. So this is also one of the way. The next are scrip dividend. Okay, scrip dividend can be in the format of a promissory note. Okay, promissory note that in future we shall be paying you either in cash or in format of stocks, the due payment for your money. Sometimes company need cash generated by business earning to meet business requirement or withhold the payment of a cash dividend because of a temporary shortage of cash. They just issue scrip or promising note that in future we shall be paying you money whenever we shall have the sufficient cash balance available. This is known as the scrip dividend system. Then there is bond dividend. Instead of issuing cash, instead of issuing the equity shareholders, the company can issue the bond dividend. So in scrip dividend, dividends are not paid immediately, but in bond dividends, instead company promises to pay dividend in future date. To the effect issues of to that effect, it issues bonds to stakeholders in place of a cash. So bonds are just, we can say these are somewhat similar to debentures. Okay, so it just issue a certificate to the shareholders that whatever your company is money is lying with us, we shall pay interest on that as well. So you are not supposed to ask for the money right now immediately, but we shall be paying you as we shall have the enough balance required to make your payment. So these are bond dividend. This is just a certificate issued by the company in consideration of the amount of equity shareholders lying with the company. Then I think this is the last dividend. This is known as property dividend, in which the company pays dividend in form of assets other than cash. Like these can be anything. This can be gift, or this can be home assets or anything like that. Okay. So instead of making the payment immediately in cash, the company offers the property dividend in format of assets. So these are known as the property dividends. So now I think you have got the basic idea of what the dividend is and what do it mean and what its relevance for us. I have already taught you that basically the reason why you have to study this topic, you have to gain the knowledge whether the payment of a dividend affects the wealth of the share or not. Wealth increases or wealth do not have any effect upon the wealth of the shareholders. So only with this knowledge you can decide whether you should pay the dividends to your shareholders or not. Okay, so answer of this question can be given with the different theories, and the first theory is irrelevance theory. Okay, so this theory has been given by the famous author who have given so many concepts under the financial management, and the author are Modigliani and Miller. This is famously known as M&M approach. Okay, so they tells you that whether you pay dividend or you don't pay the dividend, it's not going to make any kind of difference in the wealth of the shareholders. Okay, so it's not going to make any kind of difference. So this is the reason why it is known as irrelevance approach. It tells you it's a very irrelevant decision whether you should keep the retained earnings or you should pay the dividends. Okay, whether you are paying the dividend or you are not paying the dividend, it's not going to make any kind of effects in the wealth of the shareholders. So just going to read that they have given a very specific hypothesis and they have their formulas, and if you solve the questions, uh, on the basis of the given formula by Modigliani and Miller, you will come to know that really value of the firm remains the same and the wealth of the shareholder remain the same, and it's not providing any kind of benefits of retained earning. So, according to Modigliani and Miller, dividend policy of the firm is irrelevant as it does not affect the wealth of shareholders. They argue that the value of a firm depends upon firm's earnings, which is the result of investment policy only. Okay, so we can say that when investment decision of firm is given, dividend decision and retained earnings is of no significance. So we can say that the difference between dividends and a retained earning is of no significance in determining the value of firm. So this is basically the hypothesis given by them. So this particular hypothesis have some assumptions, very important assumptions, which we have to understand. Only then we can acquire the relevant knowledge of M&M hypothesis. The first are, they assume that there are always the perfect capital market situation. Investors behave rationally. Information about the company is available without any cost. There are no flotation and transaction cost, and no investor is large enough to affect the market price of the share. Then there are either no taxes are there, or there is no taxes between the tax rate of dividend and capital gain. So this is the most important assumption on the basis of which the theory of Modigliani and Miller was criticized a lot. So they are assuming that there is none kind of taxes are there, and if these are available, then there is no difference between the taxes on dividend and capital gain. Then the firm has rigid investment policy, and the final is there is no risk and uncertainty in regard to future of the firm. So this was also one of the we can say the assumption which they had to draw, because it was also not producing the value. Okay, so this hypothesis, what was this actual hypothesis? They just told that whatever the increase in the value of a firm result from the payment of a dividend. Okay, so they assuming that suppose if payment of a dividend can increase the value of the firm, okay, but that increase will exactly be offset by the declining in market price of share. So you are paying the dividend. When you pay the dividend, although the value of the firm can be increased, but this increase shall completely be offset or neutralized by the declining market price of the share because of external financing. Because of external financing means for the next investment opportunities, again you will have to issue share capital. Okay, so they just gave their hypothesis that if there is the increment in the value or the wealth of the shareholders due to the reason for the payment of dividends, that increment in the value shall completely be set off or neutralized by the declining in the market price of the share, because you shall have to depend on the external financing for the next investment profitable opportunities. So they have given the hypothesis that if you are paying the dividend, that means you do not have any kind of retained earnings. So for the next profitable opportunities, you shall have to raise the funds once again, and for that you have to depend upon external sources once again, and these sources are again either equity share capital or preference or the debenture. So you will have to raise the funds again, and their cost shall be increased, and ultimately the market price of the share shall come down, and whatever the value increment you got with the payment of a dividend, that shall completely come down and it shall neutralize. So they have given specific formulas to support their hypothesis, which I am going to show you here. So they have given the formula of a calculation of the opening price or the price at the beginning of the year. Okay, suppose this is 1st of January 2022. So they have given the formula that this should be PO should stands for market price at the beginning of the period, and this should be calculated on the basis of this equation. This is equation number 1. This is D1, that stands for a dividend at the end of the year. This is P1. This is market price of share at the end of the year. This is KE. KE stands for cost of equity share capital. And they have just given this equation for the reason that with the help of this formula, you can easily find the value of market price of the share at the end of the year. So if you keep this P1 at one side of this equation, you can easily draw this formula. Okay, so P1 is the market price of the share at the end of the period, and this can be calculated with the help of this formula. This is PO, market price of share in the beginning of the year, and this should be multiplied by 1 plus cost of equity, and dividend to be paid at the end of year should be subtracted from this, and ultimately this equation shall yield the value of market price of share at the end of the year. So their first equation to support their hypothesis was that, and the second hypothesis they gave simply, that is that if you are not retained any kind of earning, then obviously you shall have to depend upon the external sources of financing for next investable opportunities, and for that you will have to issue fresh share capital. That means you will have to issue share capital again, and you will have to share number of shares in the market, so that you can raise the funds once again. And for that they have given a specific formula how the number of shares to be issued can be calculated. So this is their formula. M stands for a new number of shares to be issued. This is 1 minus earnings already available to you. These are the total earnings of the firm during the period. N stands for the number of equity shares already outstanding in your balance sheet. These are the already issued number of shares. Okay, so this is number of shares outstanding at the beginning of the period. These should be multiplied by the D1. This is the dividend to be paid at the end of the year, and when you divide whole this equation with the P1, that is market price of the share at the end of the year, which we have calculated with this equation. So when you divide this equation with P1, you can get the actual number of shares to be issued for the next investable opportunities. Okay, so this is the second equation, and the final equation is to derive or calculate the value of a firm. So value of a firm they have denoted with this NPO. NPO stands for the value of the firm. So it is equal to N plus M, where N stands for the previously issued equity shares. M is the newly issued equity share, and this all N plus M, this should be multiplied by P1. P1 is the market price of share at the end of the year, and we should subtract the value of investment to be made minus the earnings already available, and this should all be divided by 1 plus cost of equity. And they have given this specific equation that by solving this equation you can derive the value of the firm. So this is all about that. So with these three equations, so all you can get to know that there are three equations in total, and they have given these specific equation, and they have suggested you to solve the value of the firm with these equations. In two cases, if you are paying the dividend, and if you are not paying the dividend. So if you take hypothetical values for all the items in all the three equations, then you can solve these equation, and you shall get to know the final result, which shall tell you that whether you are paying the dividend or you are not paying the dividend, the value of the firm remains same in both the cases. Value of the firm remains same in both the cases. So this is the crux of their theory, I must tell you. And we have not included any kind of a practical, because its practical is much more than 2 or 3 pages, I think. But it can clearly prove you that by solving all these three equations or following these equations, you can solve that the value of the firm do not have any kind of change if you are paying the dividend or not paying the dividend. So this is the irrelevance theory given by Modigliani and Miller. So they have suggested you that payment of dividend and non-payment of dividend is just irrelevant, and it's not producing any kind of benefit to the firm, because whatever the value you can get, this shall completely be offset by the decreased market price of the share. So this is crux of that. So now I'm going to move further to the next thing, but before moving to that, I think that we should see the criticism of Modigliani and Miller. Only then it would be relevant for us to go for the next theory. So the hypothesis of was criticized due to the following reasons. The first, assumption that taxes do not exist, but the taxes obviously exist. It can never happen that they don't exist. So also argue that internal and external financing are equivalent, like retained earnings have the same value as the external financing, but this is never the case. Then according to their hypothesis, wealth of shareholders will be remained same whether dividends are paid or not, but this is not the case. Okay, it can never happen. It's never the same, because capital gains and dividends are the separate thing, and they have a different cost associated with these two. And after that, even under the condition of uncertainty, they assume that the discount rate is same, but the discount rate or the present value of the cash or money is never the same. Okay, so it's not correct to assume that the discount rate should be same whether the firm uses external or internal financing. So this is the case. I hope you have got the idea. Now I'm just going to move further. This is the last criticism of that argues that even if assumption of a perfect certainty is dropped and uncertainty is considered, dividend policy continues to be irrelevant. But this is not the case, because number of writers tells that the situation of a perfect capital market or the imperfect market also affects the dividend decisions and the value of the firm. And after that, somebody's criticism becomes the strength of someone else. So we can say that after that, there was the next theory, which is famously known as the Walter approach. Okay, Walter suggested something different. He tells that there can be relevance. Okay, the payment of a dividend can increase the value of the firm and the wealth of the shareholders as well. And how this can increase, I'm going to explain you in a very sophisticated manner. So Professor James E. Walter has given a mathematical formulation to suggest that financial managers can use dividend policy to maximize the wealth of their equity shareholders. So he has suggested that a framework as an aid for understanding the relationship between dividend policy and stock prices. So they have given their hypothesis on the basis of dividend policy and prices of the stock. This is the market price of the stock, and they have given the relationship between these two, and they have suggested that the payment of the dividends can sometime increase the wealth of the shareholder. How this is, then it's yet to be seen. So his contribution is indicated by his formula suggesting the fundamental factor influencing the market value of the ordinary shares. So they have also given some kind of assumptions. Okay, So what are their assumption? These are to be understood deeply, because the exam can ask you these as well. So they tells you that investment of a firm are financed through retained earnings only, and the firm does not uses external sources of funds. So they highly suggest that you should retain your earnings. Okay, so the next investment opportunities can be funded through your retained earnings. So this is one of the uh, important uh, important thing. Okay, so this is one of the important assumption of the Walter approach, that they suggest that you should retain maximum earning. And then they suggest that the internal rate of return IRR, which we have understood while talking about capital budgeting, they suggest you that IRR and the cost of capital of the firm are always constant. And after that, they suggest that the earnings and dividend do not change while determining the value of a firm. If you are determining the value of the firm, then the earnings and dividends do not change. So these are the three important assumptions of Walter approach, which you have to remember, because these are very important to go through. So they have suggested some equations. Okay, so they have given the relationship between overall cost of capital, this is cost of capital, and the internal rate of return IRR, or the earning rate, we can say. Okay, so they suggest if your R is greater than K, this is the firm earns a higher rate of return on investment than the required rate of return or the cost of capital, then it should retain the earnings and dividend payout should be zero. So if you are earning more than the cost you have to bear, then you should retain the earning. Okay, you should retain the earning. And if you are earning lesser than the cost you have to bear for overall cost of capital, then you should pay 100% dividend. You should not retain any kind of earning. So your policy should be to pay all the money you earn as dividend. And finally, if your cost of capital is equal to your uh, uh, internal rate of return or rate of earning, then it's not going to make any kind of difference whether you retained your earnings or you pay the dividend. So they have suggested three criterias. Okay, the first is R is greater than K. Here R stands for earning rate and K for overall cost of capital. If this is the case, then you have to retain earnings. If R is lesser than K, if this is the case, then you have to pay dividend. And if R is equal to K, then this is your choice, because it's not going to make any kind of difference whether you can retain your earnings or you can pay the dividend. It's not going to make any kind of uh, uh, we can say difference in the value of the firm. So this is all about that. And how they have proved that, they have given a very specific formula for calculation of the market price of the share. Okay, on the basis of that, you can easily find whether you should pay the dividends, or you should not pay the dividend. So they have suggested this equation. You are not supposed to solve this equation, but still, I think that at least one practical would suffice. Everything have already been explained in detail in the PDF as well. I'm not going to solve any kind of practical, but I shall thoroughly explain this specific formula. So here is the calculation of market price per share. So it tells you that you have to calculate market price per share with this equation. This is D dividend per share. KE stands for cost of equity. This is also cost of equity. This is also cost of equity. This is earnings per share. Earnings per share. And you have to reduce the value of a dividend per share from the earning per share. And this all should be multiplied by the internal rate of return or the rate of your earnings. So when you solve this equation, you can get the value of the market price of the share. So when you shall solve one equation only, then you can get to know the idea that in case your R is greater than K, So with the different equations or with the different scenarios, we can solve this question, these kind of question very easily. One practical has been defined in detail to you. If R is greater than K, you should retain your earnings. If R is lesser than K, you should pay your dividend. If R is equal to K, then you are just irrelevant about the decision. Okay. So you can see here the R and a cost of equity or cost of capital has been used widely in this specific equation. So this is all the crux of Walter theory, and I hope you have got the idea. So they have given some specific reasoning. So the reasoning of a Professor Walter's formula is also helpful in explaining the dividend practices. For instance, a growth in one. So a growth company is one in which profitability is likely to be very high and the internal productivity of retained funds is likely to exceed the capital productivity outside the company. So they have suggested that if you are retaining your earnings and your productivity is high, you are highly profitable venture, you are having highly profitable venture, then at that situation you can earn more and more, and you are not supposed to pay the dividend. But this case should be only there if your internal rate of return is higher than your overall cost of capital. So this is the case. Okay. So they have given a specific theory. So that was the concept regarding Walter, who have given three approaches. We can say three conditions like R greater than KW, R is lesser than KW, R is equal to KW, and these are the different kind of criteria. And the next one is the Jordan's theory of dividend policy, and this is the last one. Jordan was just the pupil, we can say he was the pupil of Walter, we can say that. Myron Jordan, he has given the similar kind of a theory, but with this with a different mathematical equation. So whatever the theory of Walter we have studied, the similar kind of a theory was also propounded by Jordan. Okay. So but their mathematical equation is different, and only this is the difference between these two theories. So Myron Jordan model explicitly relates market value of the company's share to its dividend policy. Again, dividend policy and market price of share, uh, they have propounded this specific thing. Okay. So what they have suggested, we can see here, the determinants of market value of a share are perpetual stream of future dividends to be paid. So they tells you that there is the direct relationship between the market price of the share and the dividend policies or the dividend to be paid, because dividend can be helpful in the future expected annual growth rate of the company. So what they have done, that they have also seen the relationship between the rate of return, that is R, and the cost of a capital, that is K, and they tell you that these two influence the market price per share of the company. So they have given their equation in this way. If R is greater than K, then price per share increases, then you should retain your earnings. If R is lesser than K, then market price per share decreases, then you should pay the dividend. And finally, if R is equal to K, no change in price per share, whether you can pay or whether you cannot pay. Now you would be asking me a very simple question, that what's the difference between Walter and Jordan theory? The only difference is the use of retention ratio and the changed concept for calculation of market price per share. So Walter has suggested the separate equation, mathematical equation for calculation of market price, but the Jordan has suggested somewhat different approach for calculation of market price of share. So they also had some kind of assumptions, which I think quickly we have to recall. The first, there are no debenture, no debt used, only the equity is used, no external finances, only retained earnings, no, there is always constant rate of return, there is always constant cost of capital, there are perpetual and continuous earnings, there are corporate taxes available, and this is constant retention ratio. So now this is the concept of new thing, that is retention ratio in the formula suggested by Jordan. So what do we mean by retention ratio? Suppose you have earned 100 rupee and this is available to be distributed as the dividend. So you sometime you don't pay the full amount as dividend. Suppose you are keeping 10%, 80% as your retained earning, and you are offering only 20% as the dividend. So this is known as the dividend value, and this is known as the retained earning, which is also the proportion of retention ratio. Okay, so that means we can say that 0.8 have been retained, from your earnings. So this is known as the retention ratio. I hope you have got the idea. So as per Jordan rule, he has suggested the calculation of market price of share on the basis of this formula. That stands for earning per share 1 minus, this is retention ratio. Again, a retention ratio multiplied by rate of return. Then this should be subtracted from the value of a cost of equity share capital, or the overall cost of capital. And this is how the market price can be calculated with the help of the Jordan's formula or Jordan's rule. So this is all about that, I think. So if we are watching its implication are exactly same as uh, same as what Walter has given. He tells you that if IRR is greater than cost of capital, then it benefits shareholders more if the company reinvests dividend rather than distributing it. So your dividend payout ratio should be 0. This is growth firm. This is known as growth firm case. So in the case of normal firm, if R is equal to cost of a capital, you are not earning much larger than whatever you are earning, you should distribute it to your shareholders. And the final is the case of declining firm. If the rate of return is lesser than the cost of equity or overall cost of capital, then what you should do, you should pay the 100% dividend to your equity shareholders, because you are not producing much money at your disposal. So your dividend payout ratio should be 100%. So this is all the crux of this chapter and theory. And the only thing now remaining is the last argument, which also takes into consideration the we can say the value of the dividend payout ratio. This is known as bird in hand argument or bird in hand theory. This theory was developed by Myron Jordan and John Lenter in combination. So this was as a response to Modigliani and Miller's dividend irrelevance theory. So we can make its conclusion with just a single line. So they have suggested that investors prefer dividend as it is more certain. So with this line only, you can make the cracks that bird in hand argument means that whatever is available with the company to be distributed as a dividend, the investors always prefer that. Okay, they always prefer dividends upon the capital gains. They always prefers dividend. Okay, they don't prefer because bird in hand means there is always a certainty that if the company has earned something, it has to distribute to the investor. This is sure that you can get this money from the company, but whether there will be capital gain or not, this is never the certainty. So bird in hand is highly profitable than bird in the sky. Okay, so they have suggested that the investors prefer dividend as it is more certain than capital gains that might or might not appear if they let the firm retain its earning. So this was the last argument for the theories regarding the we can say dividend decision. So in this complete video, I think there was much more for you to learn and understand. We have talked in detail regarding the dividend decisions. I have taught you its type and most importantly the theories concerning the payment of a dividend. Whether this is beneficial for you to pay the dividends to your shareholder or not, that depends only upon your own understanding, and you can get this understanding only if you have the knowledge of the different theories regarding dividend decisions. So I hope you have got the idea, you have got the complete detail. So regarding the next lecture, we shall be informing you. Thank you so much. This is Gurpal Singh from Gursu Education.